Hello, my dear friends. This is CH in Hegde. Welcome to day 17. Let's learn SFM practically. Uh, Disclaimer: this video is for education purpose only. Do your own analysis before investing. Four segments in every day. Today being the Monday, previous events segments, I will not talk about it. Quote of the day: you miss 100% of the shots you never take. 100% of the shots you never take. Basically, if you don't try, you'll never get it. Many people have this mindset. We are worried, so I will not do it. That is not the way. You have to know how to manage it. In other words, don't avoid the risk. Try to manage the risk. And to manage, you have to calculate. And as usual, you would have heard many people saying that always take calculated risk. But how to calculate that risk is our topic for the day. Risk measurement, risk calculation. Of course, risk will be based on returns. Broadly, I would say the risk means the movement of stocks. If the stock is moving fast, we say that is more riskier. If the stock is moving slowly, we say that is less riskier. It is measured by parameters like standard deviation, beta, VIX, volatility index, and IV, intrinsic value. Standard deviation is based on the stock price. Standard deviation is based on stock price. Whereas beta is comparing the returns of the two. One is security return percentage and the market return percentage. By comparing the two, we calculate the movement. That is beta. So movement of one variable with respect to movement of another variable. Volatility index, that is calculated based on option price. Basically, you have bid price and ask price or offer price in option pricing, option premium. Based on the premium, based on the difference between these two, the volatility index is calculated. IV, implied volatility, is based on option price. Option price for a particular stock, based on that, implied volatility is calculated. So we will not be able to understand all of them in one session. Today, let me just focus on about standard deviation. So let me talk about standard deviation, how to calculate. I'll show you also, and more importantly, how to interpret. And we are not going to learn too much of theoretical, like what is standard deviation formula, square root of summation x minus x bar n square by n square root. No, we are not going to do that. We will do practically. We will calculate. We have a great tool called as Excel. So basically, what is standard deviation? I will give a simple example. Suppose of stock A, if standard deviation is 10% and stock B, standard deviation is 12%, which is more riskier? Which is moving faster? Obviously, you say 12% stock B, but that is not right. When you calculate standard deviation, it is a measurement of movement or measurement of deviation from average. So you have to calculate average of a stock. Suppose the stock average is 8% and standard deviation 10 means, okay, it is likely to move from 8 plus or minus 10%. And stock B, if it is likely to be, let's say, 40% plus or minus 12%. So it looks like 10, 12, stock B is more riskier. But if you compare it with the average, maybe stock A is riskier because 10% from 8, its average is a higher movement than 12% standard deviation from its average of 40. Hope you understand. So what is standard deviation? If I say 15%, that means stock is likely to move by 15% from the average returns of the stock from its average. So standard deviation is the deviation of movement with respect to its specific average. Now let us try to calculate for few stocks and for index. So for that purpose, I will go to internet. Various websites are available. I will take Yahoo Finance because it's easy to get the data stock wise. So for example, I will select our favorite stock. Again, don't take it as recommendation. Usually used for all the analysis, Reliance Industries. I hope you're able to see all these things. Yes. So there we have historical data. You can calculate daily standard deviation. You can calculate yearly standard deviation. I would prefer monthly standard deviation. So frequency, I'll select monthly. And I'll select for, let's say, last 5 years. Okay, data is there. So I will, okay, daily is no, monthly for last 5 years. Apply. Okay, the data is there. So download. So Excel is there. I will open the file and I'll take it to the Excel sheet. Just give me 1 second. Okay, so I will take it to the Excel sheet. It is downloaded. Okay, and I'll take out whatever is not required. So I required only close price. Of course, with open high, you can do more analysis. I'll stick myself for close price. So how to calculate the monthly calculation? So select the cell B3 divided by previous cell -1. So for that month, and you can make it a formatting as percentage. That is the return for that month. Select for the entire thing and you calculate. Very simple. You don't have to do calculation like your regular classes, x minus x bar whole square, like that. You don't have to do it. Okay, so I think now you got it. Excel is there now. So very simple. So you calculate average. Okay, I'll show you once more. I think some of you may not got it. So select the cell B3 divided by B2 -1. We got the month return. Copy paste to the entire column. We got the return for the all previous months. And you take the average. So if you take the average, so 2.9% on an average monthly basis, this has given return. And let's calculate standard deviation. That's also formalized there. You see standard deviation and select the data points and you are done to 9.2%. Let's say 3% and 9% approximately. So what is the 3%? What is the 9%? Reliance stock every month is likely to give an average of 3% plus or minus 9%. It can be plus 9%, it can be 9%. That is the range. Plus 9, higher range, minus 9, lower range. And keeping this range also in mind, you can create option strategies at different strike prices. And I just showed you for one stock. Like this, you can try for various other stocks like IT, like Infosys, Wipro, TCS, ITC, HDFC Bank, ICICI Bank, Bajaj Finance, whatever it is. Try to do some calculation and see which stock is less riskier as compared to its average. Don't take only the standard deviation into consideration. And you can also see that when you calculate for the stock, the standard deviations are likely to be more, and when you compare to the index like Nifty itself, you can take the data like this and calculate its average and calculate standard deviation. You see that will be less as compared to the stock, and that is why we say the index is always likely to be less risky than a individual stock, because individual stock is having a concentration risk because only one stock, whereas Nifty market index is a portfolio, and portfolio nature, some stock give you positive return, some stock gives you negative return. And that is why the movement is always likely to be controlled. Diversification risk will happen in a portfolio. When diversification risk will be controlled in a portfolio, will be controlled in the market index like Nifty. So more about it, you calculate yourself. Today we talked about standard deviation. Using the standard deviation, you can also calculate daily standard deviation, and you can try to predict the Nifty index movement, market movement, stock movement on a daily basis. Of course, you should not use only this data point, but you should use also this data point. Okay, and today we talked about standard deviation. We are going to talk about beta volatility index in the coming days. I don't want to have too many things in one session itself. Because before I come to next session, I would like you to try this type of calculation for other stocks yourself. These are all free data points. And if you don't use it, you're going to pay for it. Not for these elements, but in your life. Anyway, so let's go to the next segment. Just 1 second. Okay, so back to PPT. Previous events we already discussed. Now let us look at the future assessments for today. What is local cues? Things are still positive. Global cues, chart analysis, and my take, and overall assessment. So let's go to the. Okay, so I'll go to the website. I'll just type global indices, money control. Okay, we have. I hope you're able to see this. What does US market today? Actually, US market is closed. Anyway, Nasdaq 0.09, FTSE, European market. This is all past data 0.04, 0.75. CSE is up, DAX is up. Singapore Nifty is down. Nikkei is there. Okay, positive. Okay, so Asian market today. These are all Asian market today price mixed. So, and I will also look at Nifty 50 chart. Nifty 50 trading view. Okay, market opened up on a positive note. That's good. Anyway, let's look at it. So do your own analysis like this, like the standard deviation calculation, daily averages, and I'm going to talk about beta, VIX and all in the coming days. Okay, so let's look at what happened in last 1 month. So Nifty 50 is okay, an upward trend, and it's all-time high. So if you look at 6 months, it is, people say that Nifty 50 is making a double top. So it is all-time high. It reached, I mean, it tested once more, and now it is testing once more. And all-time high, we say it's like a uncharted category, because a territory, because we don't know what is going to happen from now, because we're not seen in the past. But if you look at the data, especially on Friday, last working day, in previous session, it was actually consolidated. Nifty 50 actually consolidated, did not move up gradually. And also, the only reason why Nifty was still positive is because of one giant stock, that is Reliance. So can the Reliance take up the momentum still continue today? We have to see. I hopefully it does, because Reliance is not performing well for a long period of time. So let's do our conclusion, our analysis. So local cues, things are getting better. Many states are opening up. So positive. Global cues are mixed. Chart analysis, I would say it's getting consolidated. My take, I'm still positive, but mildly positive. I'm not too much positive. Market will not go up drastically. But you see, market movement, they say price action, it will not go in a linear direction. It will go up, take some rest. Then it will go up, take some rest. Or if it like go up, comes down, comes up, so it will take the rest like this, and then it goes up. They say it's like a flag and pennant, like flag, like a pole, and then flag, sorry. So this is like a flag, so market moves up like a flag, I mean the pole, and then flag. There will be a consolidation, and then market moves up. I think we are in this stage now. Oh, okay. I think you're not able to see the PPT, is it? Why is that? Okay. So local cues are positive. Global cues are mixed. Chart analysis is consolidated, and my take is positive, but I'm not too much of positive. I'm mildly positive. In the sense, market will not go up straight away. They say flag and pennant, so it's like a lamp, like a pole. Market will go up, then it will take a halt. That is called as a flag, and then again market will go up. So I think we are in that consolidation mode now. So I don't expect too much of movement. I think it will be around the 15,430, 450, around that price. I think will be the today's position. So that's it for the day. Hope you have learned something new. We'll continue discussing more tomorrow. Till then, take care. Bye bye.